Welcome to a special board meeting of the Finance Committee of the Coastside Fire Protection District, March 22nd, 2022. Roll call, please, Steve Cost.
President Burke.
Here.
Vice President Cockle.
Here.
All right.
Great, thank you. And we are privileged to this afternoon to have our guest from the PAS and complete the annual audit, the update of the annual financial statement schedule. And maybe you could just introduce yourself, be easier to us, please.
Perfect. My name is Jennifer Meza. I'm from PARS. Andrew Brown from Highmark Capital Management.
Great. With that long introduction, the floor is yours.
Perfect. We're actually going to start on slide number 3, part of our introduction as well. You're familiar with the different providers within the program. PARS, the ongoing administrator, consultant. We do all the record keeping and accounting for the program itself. There are 2 other parties that have been involved in the program as well. One being US Bank, the trustee, that's where the assets are held. Secondly, it's Highmark Capital Management, who's under Union Bank. Recently, US Bank did buy out Union Bank. So in the future, instead of 3 providers on this slide, you're only going to see 2. You're just going to see PARS and US Bank, because Andrew will be under US Bank going forward. That was finalized at the end of last year. So we'll see the changes here within the next couple of months. The next time we meet, most likely it'll just be 2 providers on slide number 3.
Okay.
Slide number 4, currently you're under the OPEB trust for retiree healthcare obligations. Just wanted to remind you that the district also has the availability to put money aside for pension pre-funding. It's available to you. We have over 400 agencies that have gone ahead and adopted the combination trust to be able to use it for either or. There's no requirements to fund it at any point in time. It's just to have it at least available. So when you do have some one-time funds, you can put some money aside to address your CalPERS pension liabilities on there. So something to think about. There's no additional cost for it. If anything, assets aggregate to give you a lower fee on the fee schedule. So it's actually a benefit. And of course, you can see the benefits as well when it comes to the investment.
It is a 115 trust that's directly to the healthcare program.
The one you for pension, the one you have is for healthcare, but the one you can adopt as well is for pension.
Can I ask a question, President Burke? You say here it's a combo trust, a 150 combo trust. Would that roll up the OPEB and the pension stabilization fund together?
It doesn't put them together for accounting purposes. It's 2 different buckets. For fee purposes, it aggregates them for a lower fee, but it's still 2 separate buckets. So money for OPEB can only be used for OPEB. Money for pension can only be used for pension.
Okay.
Yes, but it's just 1 trust, so it's not 2 different programs that you would need to adopt. It's all under 1. Slide number 5 gives you a little bit more information regarding that, just the flexibility. If you were to adopt the pension portion, investments can be different. They don't have to be structured the same. Contributions different, disbursements different. So it's completely 2 separate sections. And it's very flexible as well. Typically on the pension side, your pension liabilities are much higher. What you pay to CalPERS is much higher. So what you're able to take out of the trust to pay CalPERS is also a much higher amount than your OPEB amount. Slide number 6, 7, and 8 just give you information on all of the different clients that we have under our 115 program. As I mentioned, all of these agencies, for the most part, have gone ahead and converted the OPEB only trust to the combination trust so that they do have that availability to do pension in the future. And again, there's no requirement at any point in time to fund it. It's just really a tool to be able to have available whenever you do have funds to be able to put aside. So it's just a win-win with that, and then it can be funded at any time. With that, we'll turn it over to slide number 9. We'll talk about your specific program right now, how it's been doing. We'll go ahead and discuss the investments and take a look at the market outlook from Andrew. Top portion shows you when the plan began back in 2009. Board Secretary, Fire Chief, Plan Administrators, investment strategy is being moderate. It's an individual account, so you do have customization available. Bottom portion are your assets as of February 28th. Total contributions into the trust, $2.9 million since inception and as of February. You have taken out about $1.5 million out of the program to pay for those retiree healthcare obligations. Net investment earnings, again, since inception and through February 28th, $2.2 million in the account. And your account balance as of February, 3.67 million. Slide number 10 shows you those contributions, distributions, and total assets. You can see the last contribution into the program was back in fiscal year 2017. And since then, we've seen distributions out of the trusts themselves. And we'll take a look and see exactly if anybody's not familiar with why the distributions are coming in and we're no longer seeing contributions into the account. In the next couple of slides when we review the actuarial valuation. Slide 11 and 12, we went ahead and highlighted some of the information from the total compensation systems actuarial valuation. Again, this report is not done by us, it's by total comp. We want to highlight the information and some of these key points to see if we need to discuss any changes that possibly we may need to do when it comes to the investments and so forth. The program itself, the last value date was June 30, 2020. Again, it's a snapshot in time. These numbers can, of course, change every time an evaluation is done because of different factors.
The number of retirees would probably change by one, I believe, or two, deceased person, or other than that.
Mhm. Exactly, and those kind of things would affect your liability as well. So, good point.
So can I ask a clarifying question on that? How do you know, do you get from PERS people who deceased, or what's the mechanism?
So we go based on just your total comp report. So, and then total comp is the one that would receive census information from your district.
Got it.
What report is that? I'm
So
sorry.
this is your actuarial evaluation report.
Oh, yes.
Total compensation.
Yeah. Okay. And that is presented every 2 years?
Yes,
Yeah.
it's required to do every 2 years.
Yeah. Okay.
So right now you only have 28 retirees on there. No more actives are eligible for the program. Slide 12. There is a discount rate component that the actuary provides, and it's the long-term expected rate of return for the program. It did increase from the previous valuation to 7.15. The trend is we've seen it go down. We haven't seen it go up to 7%. A lot of these tend to follow the CalPERS scenario. When CalPERS lowers it, a lot of actuaries go ahead and lower it for all types of different retirement programs and so forth. But yours actually went up directly on there to 7.15. Your total OPEB liability, 2.9, stayed pretty consistent. And again, depending on who drops off and so forth, good thing is people drop off, lower liability for the district, but also fasting people drop off. So.
And I was a little bit surprised, President Burke, that it actually went up. And I know that we do start risk after the obviously June 2020 date. But in my mind, it probably would have, could have, should have stayed near 6.2.
Well, the question is, who made the decision?
So total comp would have talked to possibly the district. Sometimes total comp will look at the asset allocation and make that determination. But ultimately, the district can discuss that with total comp and make that decision.
Often though, actuaries will talk to PARS and then PARS will connect the actuary to myself. And then we'll share with them what our our capital market assumptions are. But 7.15 that's not a number that we would have delivered to anybody over any time for balanced or moderate.
Is the 7.15 mentioned in the?
Well, we pull the numbers from the report directly.
That's pretty interesting. I don't remember that even being a subject of discussion. You pointed out, we'll find out.
Which I guess the key takeaway is that if total comp said, well, hey, Highmark, what do you think is possible for moderate?
Yeah.
We would actually say 6.1.
Yeah. And
so that would, drop it by 1%. And if the rule of thumb at the bottom of the page holds that liabilities would go up 10%, then, 2.9 goes to $3.3 million of liability, still overfunded, yay. But it's, $300,000.
And I do apologize, as I mentioned to Andrew right before my meeting. We do have a new analyst that's putting these presentations together. So give me just 2 seconds to double check your number. Because it looks like it stayed consistent. Based on my 30-second review of your report.
Well, I have a typo later on the presentation too, so
Okay,
we're in the same boat.
no. So I do apologize about that. The investment discount rate did not change. So the assumption is still at 6.2%.
Okay.
So that is a typo on there.
So it's 7.15
5 should say 6.2.
6.2, yes, I apologize. So that has stayed the same, which is in line with what we've seen up and down in California. We haven't seen it go up.
And Vice President Cockrell, we would stand by a 6.2 at least. Our assumptions would be, 6.1 something, 6.2.
So
Very
these
similar.
numbers that I'm reading are based on the 6.2 assumption.
Yes.
Okay.
I'm just double checking the rest of the numbers and everything else looks to be fine. So yes, so total OPEB liability 2.9, assets at this point in time, which is the fiduciary net position, 3.8. And so you are a bit overfunded, which is not bad. That's why you continue to take money out of the trust. We have maybe less than 5% of agencies in your situation.
Say again, less than 5?
Up and down California, it's not, most of the time we try to get agencies just to adopt the OPEB program and start funding it. Maybe most of them are, under 50%, but you're in a very good funded status, which we don't often see.
Except for today, where our two previous clients, Contra Costa Employee Retirement Association Board, we actually manage their OPEB plan. They're overfunded. Half Moon Bay, City of overfunded, and then you,
They are funded local,
100 and something.
fully
Yeah.
funded.
Oh, fully funded. Yeah.
Oh, I'm sorry, yeah.
But it's not common, but it seems to be common today.
Today,
Yeah, oh, okay.
A good day to be on your list.
And that's why you don't see contributions coming into the program. You see money coming down. The goal is always to be around 100%. But if you did need to take out money, as I mentioned, you could always take out 2 years of what you're paying out to retirees for healthcare. So not just the current year, but you can go back one prior year in case you needed a little bit more flexibility.
So somebody would do that just because they're required cash for another project?
Exactly, yes, because you've already paid it a year ago and now you want a little bit extra cash and you can.
No kidding.
That's the
So
flexibility. with
take
the
it out of
person.
retirement plan and put it into the general budget.
As long as it's for that purpose, we can re-inflate. We have to have an invoice.
This is no. Oh. No.
Oh, no, gotcha.
Yeah. So for health purposes, we just need an invoice that we paid this off and we send it back to your general fund. And with that, I'll turn it over to Andrew on slide 15.
And so just sort of the general topics that I thought we would review today would be just a kind of a quick overview on the economic market forecast. So our forecast for 2023 economic data points that you see here on page 15. Talk about performance, certainly talk about positioning for the portfolio. We had a couple of changes in investment managers that we implemented in January, and I'll provide the background on that. But really, this is our time. So to the extent that you want to make it interactive, fire away with questions. Anytime you have them. So on page 15, first row at the top of the page, GDP for 2023. Our asset allocation committee, which develops our assumptions, minus 0.5 to plus 0.3%. So just looking at these numbers for 2023, we would say modest recession, small recession. Not a lock that we'll see a recession, and we do, I guess, offer up a 0.3% upside to the economy. And I'll tell you, the first quarter GDP, when we finally get it in a couple of weeks, we're probably going to see 2.7, 2.8. So first quarter, we were able to still show some growth, but by our estimates, the second, third, and the fourth quarter will probably retrace a little bit. And why is that? Well, because last year the Fed raised rates over 400 basis points. And typically when you either raise rates if you're the Fed or you cut rates if you're the Fed, the impact is felt 9, 12, 18 months down the road. And since they started that basically March of 2022, this is 12 months down the road, and this is when we'd expect to see some of the headwind to the economy. So small recession from our standpoint, companies don't typically grow their earnings in a recession. So we're calling for 8 to 10% decline in corporate earnings for the S&P 500. So $195 to $205 range for earnings per share there. It's hard to gain employment in that type of an environment. So current unemployment rate of 3.6, we see that going up to 4.5 to 5.2%. More of us are closer to the 4.5 side of that range rather than 5.2%. Core PCE We put out an estimate for core PCE as the inflation gauge. I know a lot of people, perhaps in this room, I'll confess to maybe leaning towards CPI just because consumer price index is what I kind of grew up with, and I'm more comfortable with that. But the Fed uses PCE, and more specifically core PCE is what they try to make their forecasts off of. 2.8 to 3.3% is where the committee sees inflation at the end of the year. Right now it's at 4.7%. So here too, we would be looking for a small recession to put some downward pressure on prices this year. In the upper left-hand corner, you will see that these estimates are as of January 2023. We've had a meeting of the Asset Allocation Committee since then. And in our most recent meeting, which was actually a week ago today, we modified our Fed funds target for this year. You see 4.5 to 5%. We actually have it now 4.25 to 5%. Today, the Fed raised rates 25 basis points before the meeting started. So we're at a 4.75% level. So what this is implying from our standpoint is we get one more hike or possibly 1 to 2 cuts. And the modification on the lower end from 4.5 to 4.25 was really in response to the situation going on with the financial sector and the banking sector specifically. And when the 16th largest bank in the United States of America goes under in the span of days, you've got to respect it. I mean, the biggest bank failure since Washington Mutual. Yeah, the Fed went ahead and raised rates today, but it certainly has their attention. And if the banking situation does see more banks go under or banks assumed by a larger enterprise, we could easily see the Fed in a position to cut rates. Right now, the market, Fed funds futures market, is calling for a 3.75% Fed funds rate at the end of the year, which I think is a little bit drastic. Our team thinks it's a little bit drastic, but you know, that implies what? 4 cuts. So
By the end of 2023,
by the end of 2023, Fed funds
4 cuts?
futures. Pardon?
4 cuts by the end of.
That's what the Fed funds futures is calling for. So the market is saying, hey, J-Pal, you ain't gonna be able to keep this up. You're gonna buckle under. You're not gonna get your wish list of getting inflation from 6% on CPI to 3%, much less 2%. So I offered my commentary ahead of time before I said that, but yeah, the market thinks the Fed's going to be cutting. So summary: a small recession this year. Page 16 has the performance figures, and I know I send this out on a quarterly basis to most of the folks in this room, but just as sort of a refresher in terms of how this exhibit is set up. The column headers are time segment periods. So we have a year-to-date, quarter, 1 year, 3 year, 5 year, 10 year, bless you, and then inception to date period. Inception to date started back on July 1st of 2009. You'll see the rows designated by black colored font or maybe lighter brown colored font. The black colored font, the darker font would be our investment returns for some specific asset class in the plan. The lighter brown would be some type of representative benchmark. And all of these investment returns are as of the end of February, so they're as fresh as we can provide them. It is so much as we typically meet on an annual basis. I'm kind of focused today on the 1 year column, which is third over from the left. But since I've been the main portfolio manager in this engagement since day one, my fingerprints are on all these numbers, so have at it if you have any questions on any of the on the segments. I'll start at the top of the page with cash and cash equivalents, and this is really our money market return. And if there is one positive element to the Fed raising rates over 400 basis points in a year, is that money market goes from basically 0 to, well, right now our money market yield is 4.4%. Over the last 12 months, though, we've generated a return north of 2%, 2.16% on cash money market. If the Fed did nothing going forward, yeah, we would probably expect to get at least 4.5% on our cash investments for the next 12 months. But that's if the Fed does nothing. The negative side to raising rates over 400 basis points is on line 3, where our fixed income minus 8.36%. So interest rates up, bond prices down, probably one of the few things people remember from finance class. That's felt in spades with respect to our plan assets. minus 8.36 is a little bit worse, a little bit less worse than minus 9.7%, but make no mistake, this has been one of the worst 12 months in fixed income investing since the 70s. You got to go back that far to find a 12-month period of time that was as disappointing. And if we gave, well, I sent you numbers as of the end of December, those numbers were minus 12%. So calendar year 2022, the benchmark was down minus 13% and we were at minus 12%. So very difficult time in the fixed income market. That said, where we are today is very attractive yields. And so our bond managers can invest their fresh money into higher yielding bonds. So on a go forward basis, you know, I mean, you look at the 10-year number, 10-year annualized, this plan has generated 1.29% on our bonds. Just miserable. And it's not that I pick bad bond managers. It's because interest rates are so low, yields are so low. There was no fish in the pond to fish for. But going forward, I mean, with yields at 4 and 5% and higher in some cases, bonds can do what bonds should be doing, and that's generating 4.5%, or maybe even higher over the next 12 months type of returns here. And if you think about it, and I don't mean to be harping on bonds, but our fixed income at minus 8.36 and our equities row 5 at minus 8.22, bonds over the last 12 months have done worse than equities at a minus 8.22%. And really, with respect to stocks in 2022 or even the last 12 months, you know, diversification hasn't helped us at all. You know, basically mid-single digit numbers or high single digit declines for all equity categories. Our large cap funds were minus 9.5%, mid cap minus 5.2%, small cap minus 4.65%. The international segment was minus 7.66%. And then REITs, real estate equities, were our least attractive, least performing category at minus 13.12%. Putting it all together, and it kind of foots with the math if you think about, you know, bonds down 8, stocks down 8, but your cash got you 2%. Yeah, our total return is right there, right around minus 8, minus 7.93% for the trailing 12-month period of time. That's certainly the bad news. 2022 is the worst calendar year that I presented to the district since inception. You know, I think 2018 we were down probably about minus 4, minus 5%. Yeah, this is easily the worst period of time. We've been very fortunate and blessed to have started at a very good time. July 2009 wasn't exactly March 13th, 2009. It was the low point from the great financial crisis, but don't be greedy. It was a great time to just to start the plan.
Andrew, if you, as the firm decreased their investments in real estate ETFs or anything?
We are underweight a smidge. So we had that put to a vote in our last asset allocation committee meeting last week, and it was 3-3. It was a push. So no, but it was up for consideration, and there was a motion there. I was one of the 3 that voted to reduce the position. And really, I mean, the banking crisis certainly has our attention, but when we think about the next shoe to drop, what I'm saying is, it could easily be commercial real estate. And then there's a lot of banks that hold commercial real estate loans on their books. Yeah. And there's smaller banks, right? I think it's like 40 or 50% of all commercial real estate loans are held by banks with less than 100 billion in assets. So they're not big banks, and so it's a big representation on their loan book. Mm-hmm. And if there's some defaults, if we're wrong and the recession's a little bit worse than minus 0.5%, you could see some delay in payments or some defaults, and that could be the next shoe to drop. So I'm thinking about that. I mean, our REIT allocation is 1.5% to begin with. So in my thinking, let's just go to 0. But as I said, I didn't have the majority on that. Let's go to page 17. And page 17 has my typo for the presentation. I apologize for that, and we'll send out a revised copy tomorrow when I get back to the office. The moderate allocation, the moderate investment objective is 40 to 60% stocks, 40 to 60% bonds. And so I think my assistant maybe took a template from a previous version of this. And you'll see the second column on from the right, where it says 50 to 70% stocks, 30 to 50% bonds. And no, that's incorrect. It's 40-60 stocks, 40-60 bonds. And you can see from either the dollar amount in the far right-hand column or the percentage basis in the far left-hand column, 2 columns over. We currently are at roughly 48% stocks, 48% bonds, and the residual 4% in cash. So I guess it's evenly balanced from the standpoint of exposure to stocks and bonds. We would say, though, given a 40 to 60% range, we're a little bit underweight equities. If equities midpoint of 50%, 48% would be a little bit underweight there. And really our rationale is if we're going to a recession, might be a little bit early to be overweight equities. Sometime in the recession, I mean, if we get the call right, sometime during the recession, we'll be overweight stocks. And you don't wait till, everything's good before you invest in stocks. You do kind of have to invest when it's down. And so, yeah, won't always be underweight equities, but right now we are based on our worldview.
Okay.
Yeah. Before we turn the page, I do want to talk about 2 investments that we eliminated from the portfolio. The first one would be in the fixed income section at the bottom of the page. And it's the 1, 2, 3, the 4th line item, the PIMCO Total Return Bond Fund. And if you look at the allocation, it says 0.00. There was actually a smidge of a dividend payment that was picked up, and thankfully so, because I can talk about it. We sold this fund in January. And one of the things that got this fund on the watch list last year, in the 3rd quarter of last year, was that they had a turnover at the managerial level. The head manager for this fund left, PIMCO. And initially it was couched as taking a leave of absence. And we all kind of go, that doesn't seem right. Just looking at the performance. And so we put it immediately on our watch list because one of the things that gets you on our watch list is manager turnover. And we did more due diligence. And as we did more due diligence, I mean, and PIMCO is one of the best brand names in the business in terms of fixed income. But as we looked at the 1, 3, 5, 10-year period of time, they were below the median in terms of the peer ranking. And the performance was at best matching the underlying benchmark. And we're paying about 47 basis points for exposure here. So that's not what we want from, PIMCO or anybody. So we put them on the watch list and we said we're going to have an exhaustive due diligence with the team in early January. And on January the 4th, we had a good hour-long session with our entire team and their group. And I'll be frank with you, we walked away just thoroughly disappointed. They couldn't have been more arrogant about very average performance. And it didn't take us, I think 24 hours later, we made a decision to eliminate them from the plan. And a week later, we were out. So, and I had roughly, for me, 160 million exposure in the plan. So they were out. Another portfolio or the other investment that I want to talk about, 1, 2, 3, 4, 5. It's the 6th row on the equity section. It's actually the replacement, the iShares S&P 500 Growth Fund ETF. It replaced the T. Rowe Price Growth Fund that we had in the plans.
Which one?
Well, the replacement is listed here. We replaced the T. Rowe Price Growth Fund with the iShares S&P 500 Growth ETF. So T. Rowe Price is somebody that back in 2007 we started our first position with them. So they were in the district's plan since day one in 2009. Solid manager, solid firm, but just 8-9 quarters of underperforming performance versus the S&P 500 versus the growth index versus peers. And we try to give them every chance possible. I mean, we're not married to any of these managers, but when you're with somebody for 14, 15 years, you do want to give them every chance to work their way out of it. They didn't, so due to performance reasons, we eliminated from the portfolio in January. And for the time being, we replaced them with an index fund. We are doing a search for an active manager for large cap growth. We have a manager in the bullpen, so to speak, but frankly, it's it's an average performer at best, or we're searching for a replacement for them as well, so. If I can't find a manager that I feel confident in, I will use an index option. You know, and get exposure to the
The
benchmark.
ice shares is just an index, okay.
Yeah. Yes, sir. So those were the two managers that I wanted to highlight, or illustrate, and not highlights. And then just on page 18 and 19 are the underlying, performance returns for the managers and the plan. And, and yeah, I mean, if you have questions, on any of that, the economic outlook, performance, managers, tactical shifts.
And this is somewhat off the subject, but, and you may cover it again, but what is the PA's position relative to ESG policies of any kind of funds or potential investments?
So I will speak to the Highmark side of that. PARS might have a different take as the administrator. Highmark, first and foremost, we see ourselves as fiduciaries. And fiduciaries need to focus on investment returns first and foremost. And there are certain issues that are important to our clients. But from our standpoint, we have to put that aside. And we don't do an active overlay ESG on the E, the S, or the G with any of these investment managers. And I know that sometimes that's a sensitive topic. It seems is more of a sensitive topic with cities, towns, and coastal regions.
It's not sensitive today. I think they're going to be.
Okay, well, all right. Yeah, that's where we stand. Now other regions, County of Monterey, Santa Barbara, sometimes we talk our way out of the deal. When we say that, Emeryville, but we got to do what we do.
Well, I don't want to digress with the statistics, depending on what you read on what day, you make it sound good, either honoring the ESG commitments or ignoring them. Obviously, I think it's best to ignore them and stick with your fiduciary responsibility.
And for private clients, if any of you, want me to manage your private client assets, yeah, I'll customize anything along the E, the S, the G, because we can do that. But these are fiduciary assets, with the plan participants as the beneficiary, and we can't do feel good things to make us feel good and
Okay.
at the risk of everything else. Oh, and I'm recorded. That's good. That's good. Oh, I'm on record. Okay, that's my report. I'll hand it back to Jennifer, but if you have any other questions, fire away.
So that's the end of our presentation. We don't have any other information. We'll make sure that we update those two typos, send it back to the team so you have the latest and greatest. But let us know at any point in time if you have questions, concerns, something happens to the market and you want to pick up the phone and just call us, please do so. You have all of our contact
Please.
information to do so.
And let me ask one quick question on that. Is my distribution list the correct one, the most appropriate one update for the quarterly updates? And I have both you on there.
It's the question that I don't know. I received it and I know the chief does, and I do not know what board members. I brought it to our board members and handed it out, but whether the other board members receive it or not from you. The answer to your question is please make sure they do it. How's that? And we'll get you the updated list.
As a follow-up, I'll send out the distribution list and it'll
Okay.
just update me.
Yeah.
And
Well, we can distribute it however you want to do it, but I'm not sure that all our board members do the detail.
Yeah.
They get to some of it.
Yeah.
Yeah.
good. Sorry.
And then at the end, we just provided performance sheets for our portfolios that are available. You're in a customized account, so it doesn't correlate to any of these specifically, but at least you know the different options and what's available and whatnot. Any other questions, concerns, thoughts? Any thoughts on the pension program? Would we like to discuss it further? The 115 program for pension, has the district thought about possibly utilizing that?
I would say not at this time. We're interested in it. We have We're underfunded, not on CalPIRE, obviously, but our previous union, we have obligations in that area. But at this particular moment, we're engaged in the major capital building fund here, building the fire station. I'm just guessing that after some of the financial facts are known in that construction, that we would be interested in some type of a program to address retirement funds. But it's in the future.
Let us know, we can always come back and talk about that in more
Oh,
detail.
I think it'd be welcome, we'd love to have to do that, but just the timing right now, I'm not sure it's correct.
No problem.
Okay, Deidre, you know,
No, I was just like, I'm just reading through this thing here, this is on the document, so.
thank you very much. It's been very informative, up to date, and we thank you for your great performance in the past. Keep it up.
Thank you.
Thank you.